Welcome to part 2. Let us start out with T accounts. Looking at assets which have debit balances, all transactions on the left side of the T account increases the balance and the right side decreases the balance. We call the left side the debit side and the right side the credit side. We say that asset accounts have a debit balance, which also means that they are debit in nature. All accounts with debit balances increases with debit entries, and accounts with credit balances increases with credit entries. Coming back to the 5 main categories, expenses, like assets, have debit balances, which means they increase with debit entries, and liabilities and equity and revenue have credit balances, which means that they increase with credit entries. We learned that all assets will be equals to liabilities plus equity. Hence, it makes sense that assets have opposing balances to both liabilities and equity items. This works the same for expenses and revenue items. The balance sheet is a statement that measures the firm's total assets at a single point in time, whereas income statements measure a firm's performance for a given period, i.e. a quarter or a year. And this resets to 0 every new period. So let's take a look at another building block in accounting, general journals. We'll see how general journals interact with T account in this slide. So looking at transaction 1, the entity received $30,000 in cash from investors as share capital. We know that there is an increase in asset, that is cash, and an increase in owner's equity, that is share capital. We will then need to debit assets and credit owner's equity, both signifying an increase in each of these balances. So in all transactions in accounting, the debits must always be equals to the credits. This is the format of the general journal. We've got the date, the accounts, and the debit and credit balances. We've got the debit item that will be above and aligned to the left, and the credit item will be below and indented to the right. The description will be a simple one that reflects the details of the transaction. Debit amounts will be on the left and credit amounts will be on the right. These entries will then be posted into the T accounts. Since cash is an asset account and has a debit balance, we will debit the cash account to represent an increase, and the description will be the name of the corresponding T account, share capital. On the other hand, we will credit the share capital T account, and the description will also be the corresponding account name, cash. The second example says that we purchased equipment for $10,000. This immediately tells us that there is an increase in assets being equipment, with a simultaneous decrease in assets being cash. The general journal will look like this, and the cash T account will reduce by $10,000, description being equipment, the corresponding T account. The equipment T account will increase by $10,000 with the description being the corresponding T account, cash. Let's look at a third transaction. For the third transaction, we made a sale of $2,000. We will increase cash by $2,000 and recognize a revenue amount of $2,000. This will be the general journal and the T accounts. We can think of the corresponding T account idea as a question we ask ourselves every time a transaction occurs. Why did this account increase or decrease by this amount? Let's look at one last example. We bought supplies on credit from suppliers amounting to $10,000. There is an inflow of goods but no outflow of cash since this transaction was made on credit. We will hence debit inventory and credit accounts payable, which essentially means money we owe to our suppliers. A credit denotes an increase in the account, and this will be the T accounts.